IMF Corner on CNBC TV18. I'm Vinny Motiwala in the Mumbai studio. Today we'll be discussing and focusing on investing via mutual funds versus a portfolio management service, or PMS as we know it. Now, how will we be discussing? We have our experts. What should we be focusing on? We have Rahul Jain, President and Head at Nuvama Wealth, as well as Mohit Gang, co-founder and CEO of Moneyfront, joining in with us to help us understand what's the best investment strategy between mutual funds versus a PMS. Good afternoon, gentlemen, and thank you so much for joining in with us this afternoon on CNBC TV 18. And it's a very important topic that we're talking about, right, in terms of investing between mutual funds and a PMS. I'm going to start with you, Rahul. Let's talk about, firstly, just the major difference that one should be watching out for between a mutual fund and taking up a portfolio management service. What is the main difference that we're watching out for there?
Good afternoon, Vinny, and thanks for inviting me to the show. So as per your question, the basic difference between a PMS and mutual fund, I think the first and foremost is the minimum ticket size or the minimum amount which you can invest in a PMS has to be 50 lakhs. And for mutual fund, it is 5,000 rupees in lump sum side. So somewhere you get an idea that if you want to invest 50 lakh rupees, at least the investor should be experienced. And on the other hand, if someone is starting new to the capital markets and wants to invest in the equity markets, then mutual fund might be a better route. So this is the first difference. Second is the whole operating model, which is different in both the cases. So in a mutual fund, it's pool of investors who come in and they have a common allocation of the portfolio, common stocks effectively in their portfolio. On the other hand, in a PMS, it is the investor's Demat account which gets opened, and any transaction done happens on his Demat accounts. So this is the second difference effectively between a PMS and mutual fund. And third, I would say in the mutual and PMS parlance, the flexibility what a fund manager gets in the PMS side is far higher versus a mutual fund. And to just give you some example, a mutual fund manager cannot invest in a stock more than 10%, while there is no such restrictions available to a PMS fund manager. There is like in a PMS, you can also buy unlisted stocks. In a PMS, there is no defined universe effectively. Suppose there is a large cap PMS, the fund manager can pick up any large cap. But in a mutual fund, you have to be in the top 100 companies, 80% has to come from there. So this is the core difference between a mutual fund and PMS effectively. And I think keeping this into mind, the client or the investor should look at what is most suitable.
Absolutely. Right. What, coming to you also, which is that same thing. Obviously, we spoke, about in terms of what is highlighted in terms of the minimum amount that you invest in mutual funds, in terms of the investments that are made by PMS as well as mutual funds. Anything you want to add on in terms of risks as well?
Look, I think Rahul has very well effectively answered everything in terms of the key differences between a mutual fund and a PMS. But in terms of risk, yes, I think PMS is a higher risk product, considering that it is a more concentrated product as compared to a mutual fund, which is a slightly large diversification across a larger basket of stocks. A PMS will be concentrated, let's say, across 20 to 30 stocks at best. So obviously, higher concentration gets in that higher element of risk. It is also a more active strategy of moving in and out of stocks, right? So unlike a mutual fund, again, which is more like a slightly more longish buy and hold kind of a strategy, though fund managers do rotate between stocks and sectors out there. But typically PMSs have a faster rotation and a faster route of moving within stocks. One more minute difference, if I were to call it, is also the expense ratio. Typically PMSs charge a little higher than a normal mutual fund would be, and a typical expense ratio in a mutual fund would be between 0.5 to, let's say, 2% annual expense ratio. On a PMS, it could be anywhere from 1% to 2.5%, and there could be an element of profit sharing as well involved out there. And one last minute difference is on liquidity, which to my mind is a little higher and more easy when it comes to mutual funds. For retail investors, the liquidity is fairly easy. In a PMS, there could be certain exit clauses or exit conditions, or maybe higher exit loads for exits, right? So all of these are finer differences between a mutual fund and PMS.
Absolutely. So, these are the key differences, viewers, that are spotted out by both our experts. But, Mohit, we spoke about that high-risk investment, how PMS becomes a high-risk investment. Obviously, does that entail higher returns possibility versus a mutual fund as well?
Look, Vinny, I've always maintained that there are many paths to God, right? So it all depends on an investor. What path does he want to choose, whether he wants to go the PMS route or a mutual fund route. Finally, ultimately, I think the ultimate destination has to be very clear as to what your financial goals are and where you want to reach. But yes, anything which offers you higher return will always, or anything which implicitly promises you to offer a higher return, that's the promise in a PMS, that they will offer a higher return as compared to the benchmark and as compared to other mutual fund products also, right? So there has to be an element of higher risk. Nothing in the world is free and comes without risk. So yes, PMS are much more risky as compared to a normal mutual fund. So investors have to be absolutely aware of that. And that's where I think regulators have also taken cognizance of this fact and increased the minimum threshold of investment in a PMS product. So yes, absolutely higher risk and higher promise of return as well.
A higher risk, higher returns as well. Nothing comes free. That's a word coming in from Mohit. Rahul, do you concur with this as well? Nothing is free in this world. So if we are looking at higher returns, we should be prepared for that high risk as well.
So obviously, risk reward is the most important governing factor on the same. But I would also say that it is not good to generalize that PMS are more risky versus mutual fund, because it depends on what category you compare with, correct? So, for example, is a large cap PMS more risky than a small cap mutual fund? Answer is no, because large cap by virtue is less riskier. As Mohit uh, spoke about, saying that yes, PMS comes with concentration where the fund manager has more flexibility. Obviously, because of this, there is far better chances to generate alpha. And once you generate better alpha, and obviously that will have some consequential risk. But yes, PMS allows the investor to have a more flexible portfolio if that what the investor wants.
Okay. Surely that's what they should be looking at if they want that. But, let's move on. And I just want to understand, can investors actually get into the investment decisions when it comes to investment via PMS? And are there any different types of PMS investments that one can have and that one investor can look at? Rahul, you take it up first.
So there are two categories in the PMS side. One is the discretionary one, where the investor has no say in deciding the investments, and it is the fund manager who takes all the calls. Then there is this whole non-discretionary one, where every investment done, or I say the investment done, is with due consultation with the investor or the client. So to answering you, yes, there are PMS options which allows active consultation between the client and the fund manager.
Okay. And Mohit, what's your take on this as well? Different types of PMS investments. What would be the best one that one could be looking at if they are going for a PMS side as well?
Look, honestly, without any doubt, the larger chunk of the industry is discretionary PMS, where the fund manager is completely entitled and entrusted by the investors to take any call which he deems fit. But there are certain investors who are restricted by virtue of their professions, or there are certain investors with particular kind of a belief that they don't want to enter into a specific sector or a specific kind of company. So for them, those kind of investors, then you have to go to the other type of PMS, right? But otherwise, yes, a discretionary PMS is by far the best bet.
Okay, discretionary PMS is the best bet if you're looking on that side. Mohit, you were highlighting a bit in terms of expense ratios as well earlier. What I want to understand as well, overall, investors have to look at that cost front of investing as well, right? What is costlier in that case? Mutual fund or a PMS? What is it that we would be paying more money as an investor then?
Look, Vinny, it totally depends on what kind of a product you are selecting. I can go into a normal index fund with direct plan today at an expense ratio of 10 bips to 20 bips, which is the lowest I can actually start investing my money at a very flexible ticket size, right? So the flexibility is a large part of mutual funds where you can invest at 500 rupees, 1000 rupees, right? But when it comes to a PMS, there is no such flexibility of opting for a very low cost PMS product. The PMS products, even under direct plans, will come at a minimalistic cost of, let's say, 1% or 1.25% on an annual management expense part. But typically, the PMS expense ratio ranges from 1% to 2.5%, and it depends on the investor whether they choose a variable method of fee or a fixed method of fee. So under the variable method, there is a profit sharing, and that profit sharing could be 80-20, 90-10. Again, there are multiple structures available in the industry, and that profit sharing typically starts after a hurdle rate, and that hurdle rate could be anywhere between 8 to 12% with a high watermark typically, right? Again, there could be multiple different kinds of structures around this. But if you put all of this together, the PMS product, because of its ticket size, because of its fast moving nature, right, and because it has a promise to deliver higher returns, is a more expensive product. And as I said, a mutual fund, again, the expense ratio can range anywhere between 0.5 to 2%. I'm talking of equity mutual funds out here. But again, if you were a pure play passive index fund investor, then you can get in at a cheaper cost also.
Okay. On that note, viewers, we're going to slip into a very short break, but don't go anywhere because we'll continue this conversation and discussion with both Rahul as well as Mohit. So do stay tuned in for more updates after this. Welcome back and thanks for staying tuned into MF Corner on CNBC TV18. Today what we're discussing is mutual funds versus PMS. As an investor, what is more interesting? What is the difference between both these? And our guests are still with us. We have Rahul as well as Mohit, both of them still joining in with us. Thanks, guys. And, Rahul, let's move on to the next one. That is important is in terms of transparency. Is there a difference in terms of the compliance that we're seeing in mutual fund versus PMS? Is one more transparent versus the other? If you could just give us an understanding on that.
So, Vinny, if you look at both PMS and mutual fund, both the categories, they are governed by the SEBI, and there has been set guidelines, and both are equally transparent. So, a matter of fact, they release a monthly fact sheet for both PMS and mutual funds every month. Investors get a statement of their folios every month. An investor can access the AMC or a PMS website and see what is the details regarding the transactions or the portfolio. And obviously, I would say that a lot of people do a lot of educational webinars, etc., speaking about the different categories, different schemes, different items on the PMS side or the mutual fund side. So from transparency point of view, compliance point of view, I would say they're equally similar and are on the same footing with both the concerned mutual fund and PMS.
Okay, so transparency and compliance, not much of a difference. But what, I just had a question on this front. That do you think the PMS compliance requirements, they are stringent but less frequent in terms versus when you look at a mutual fund also? Is that something that one should be watching out for?
Look, Vinny, I think I broadly concur with Rahul on that. Just that in case of a mutual fund, because it is a retail product, right? The regulators are quite stringent in terms of disclosures and frequency of disclosures, right? So in mutual funds, you will find riskometers, the color-coded risk ratings of the schemes. You will find lots of data around risk ratios being published in the fact sheet, right? So the amount of data and the info which is getting circulated is pretty much standardized by the regulator and has been made mandated at different frequencies, be it fortnightly or monthly, right? In terms of a PMS, the disclosure requirements are of course there, but not as detailed perhaps, which might be the case for a mutual fund, and that's more to do with the category of investors and the hawk eye with which the regulator kind of monitors the mutual fund industry. But otherwise, yes, I think the requirements are fairly stringent for both of them.
Fairly stringent. Mohit, let's also talk about some of these important points or factors that one should consider while investing in a mutual fund and while investing in a PMS. If you could highlight for both these, what is it that important a few points that an investor should look at?
Look, Vinny, again, as I say, one has to finally look at crossing the swamp and not fighting the crocodiles. Honestly, whether you do it through a PMS or through a mutual fund, these are all vehicles to reach your financial goals and objectives, and one has to be clearly focused on what you want to achieve in life and what are the means and modes for it comes next. So first and foremost, I think the capital available is the bigger question when you decide a vehicle of investment. If you have the capital availability with you, wherein you can forego a tranche of 50 lakhs and above at one shot, then of course PMS is a vehicle which will reward you in a much better way. Right, but you have to have your basic structure ready, which means that your mutual fund allocations should have been done. My sense and argument always has been that first comes your mutual fund allocation when you want to build your equity portfolio. Once you have achieved, let's say, around $500,000 kind of a portfolio, which is 3 to 4 crores or around that corpus, that's when you start looking for alternative forms of investments, and that's when you start building other assets in your portfolio. Your risk appetite will come into play here. If you are a slightly more conservative profile within the equity category, then you might just want to stick around with mutual funds, which are a relatively lesser volatile, right? And if you can bear higher risk, higher volatility, concentrated portfolios, then yes, PMS is the option for you. Again, time horizon also comes into play out here. So both are equally long duration products in the sense that when you're doing an equity investments, you have to be looking at a time horizon of 3 to 5 years. But PMS, again, you really need to stretch your horizon at times. And the last thing to my mind will be basically, are you comfortable or you really want to go for those exotic or differentiating themes? Mutual funds at times could be fairly simplified products that you have a large cap, you have a mid cap, you have a small cap, and maybe some different themes at play. But if you're really choosing for PMS, then you might just want very tailored and customized products which are available in the market and niche kind of PMSs. So if you're really looking for those, then yes, PMS perhaps is the answer for your questions.
Okay, surely. Thanks so much for highlighting those factors. Rahul, coming to you, while factors are surely put into place of what we could be looking at, what is it that, one investment in PMS as well as mutual fund, what is the best strategy? What should one be doing here?
So I'll repeat what Mohit also said, that whether it's a mutual fund or PMS, that is not very important, I would say, because those are vehicles of investing into different asset classes. I would say that an investor or client first should understand his asset allocation, identify where he wants to invest. For example, if he wants to invest in equities, whether it's large cap, mid cap, small cap, whether he wants to do a multi-asset allocation in that sense where you have debt, equity, gold all coming together. So I think that understanding and figuring out that is the first and the most prominent one. Then I would say that once you're identified, clear on the asset classes or subdivision in terms of a large cap, small cap, then the next steps comes in where you identify the right fund houses, the right fund manager, and then accordingly, once that is also done, then you can obviously move into a PMS or a mutual fund very seamless, because for example, a fund manager which you like, who has a lot of pedigree of the past, have done delivered better, well, and you want to invest in mid cap, then why not go into that PMS fund manager and invest with him? So I would say understanding your asset allocation, then going below understanding the right fund manager, fund houses, and then identifying between mutual fund and PMS. And I would say that there is nothing wrong, or it's all right to have both mutual fund and PMS. If you remember, the Mohit said that start with mutual fund and then go PMS. So I think a combination of both works well. And end of the day, I think the important point is that how much is the investable surplus? If it is above 50 lakhs or a bigger amount, then dabbling into PMS is an option. But if it's below, then there is no option available. Then you have to work with mutual fund. And I think that also you can make a very good quality portfolio across different categories.
Okay, absolutely. And just Mohit, last one word quickly. We're just absolutely out of time. But PMS mutual funds, which one should opt for what? Quickly.
Look, it's a tug of war out there. If you have the available capital and the risk appetite to digest it all, by all means have both. I concur with Rahul on that point. My only humble submission to all investors is let's first build a reasonable corpus of mutual funds, and reasonable is a definition which is subjective to each investor. Once you have done that, I think by all means go ahead and do the PMS. Though regulator is making it easy, they're coming with other asset class at a 10 lakh ticket size. So pretty soon you will have affordable substitute of PMS also. But yeah, only time will tell how successful it becomes.
Okay, Mohit as well as Rahul, thank you so much for joining with us and making our viewers understand the difference between mutual fund and PMS. So thanks for removing your time today. But with that, we're absolutely out of time on this edition of MF Corner. Thank you so much for tuning in.